All right, so now we will be dealing with the workings. Okay, the first working is working number one, the group structure, that how much percentage is acquired by the parent in the subsidiary. The best case will be that it is given to you in the exam. The other case will be that you have to calculate it. So if you need to calculate it, then how you can calculate it? So the number of shares acquired, it will be given in the exam, that how much shares you have acquired, divide by total shares of subsidiary. Total shares of subsidiary, which you're going to take from the subsidiary's balance sheet. So multiplied by 100, that gives you the percentage. So number of shares acquired, divide by total number of shares of subsidiary, multiply by 100, and it gives you actually the percentage. But remember one thing, that when you are going to take subsidiary share from the subsidiary's balance sheet, you need to see, say for example, if this balance is written that 8,000 and here it is written $1 share, then that means the total shares are 8,000 because one share is for $1 and the shares will be 8,000 similarly. And if it is written, say for example, $0.5, then that means the total number of shares will be 16,000. If it is written that it is 0.25, then that means total number of shares will be 32,000. So you need to remember this concept, that okay, how you going to calculate. So you need to see this one, $1, $0.5 or $0.25. So that gives you the total number of shares. So this concept should be remembered. Then you have net assets of subsidiary. So net assets of subsidiary at acquisition, which is the acquisition date, and at reporting date, which is the balance sheet date. Share capital and share premium, this will remain the same. Then you have the share premium, this will remain the same. And then you have retained earnings, it will be different at acquisition and it will be different at reporting date. So you're going to take this retained earning at acquisition from the statement of financial position, or you may be required to calculate it. Similarly, retained earnings at reporting date, this will be given to you in the statement of financial position. So now let's discuss that what is that case in which you will be required to calculate the retained earning at acquisition. So sometimes in the exam, you may be required to calculate retained earnings at acquisition. And that is the case of mid-year acquisition. Like for example, if the best case is that the examiner gives you the retained earning at acquisition. But the other case is that they have acquired the subsidiary midway through the year. Midway is not like exactly in the center. Midway is any month during the year. So say for example, if the year end of the subsidiary is 31st December, but they have bought the subsidiary in March, that is also the mid-year or midway acquisition. So there are two ways to calculate the retained earning at acquisition. Two ways. Okay, first of all, let's just see the timeline. Okay, for example, the 1st January is the start of the year, and 31st December is the year end. 31st December is the year end, 1st January is the year start. So they have acquired the subsidiary, say for example, in March. Okay. Now this is the acquisition date. And you need the net assets of here, net assets at acquisition. There are two things. A full year. Now there are two things. You need the net assets Okay, now value would be studied, like for example, it may be positive or negative. And extra fair value, if you have to deduct it, then minus it. If you have to add back, then add it. So it goes actually vice versa. If there is upward fair value adjustment, the appreciation will be deducted from the reporting date. If it is downward, then the appreciation will be added back. Then you have the unrealized profit. If the subsidiary has sold to the parent, then it will be deducted from the reporting date. And if then you have other adjustments. Other adjustments may be any adjustment, like say for example, in the subsidiary books, and now those assets does not worth anything, so you will be deducting that. Similarly, if there is a liability of the subsidiary which has not been recorded in the books and you need to record it, so you will be recording here these other adjustments. So when you calculate all these things, these are the net assets at acquisition and these are the net assets at reporting date. When you compare these two, it gives you the post acquisition. And this post acquisition will be shared between the NCI and the parent, because this is the profit which has been earned by the subsidiary after the acquisition. And if we have acquired subsidiary as 100%, then obviously 100% belongs to us. But say for example, if we acquired belongs to us and 30% to NCI. So this post acquisition profit means this is what subsidiary has earned after the acquisition. Now you have the goodwill. Goodwill may have, first of all, the consideration. The consideration, you know, I have already explained it. It may have cash, loan notes, share exchange, contingent consideration, deferred consideration. So these all are the consideration. Then you need to add the non-controlling interest. Now you will be asking again why we are adding the non-controlling interest. So say for example, actually we are consolidating the whole subsidiary. So the goodwill will be of the group. So that means this is the consideration, for example, which is paid by the parent, for example, 80%. The other 20% is paid by the non-controlling interest. So you will be adding that other 20% consideration as well. That gives you the full consideration. Then you will be deducting the complete net assets of the subsidiary, which you have calculated in the working number 2 here. This is the net assets acquisition. So if you want to deduct the complete net assets of the subsidiary, then you need the full consideration as well, which is for parent plus the others. Again, in the non-interest, the most easiest case is that the fair value is given to you in the exam. This is the most favorable case. If it has not been given to you, then you need to see which method examiner is saying to follow. Is it fair value method or is it proportionate of net assets method? If it is fair value method and fair value is given, well and good, fine. If it is not given, then you will be taking subsidiary shares, total share of the subsidiary. When you multiply it by NCI percentage, that gives you the NCI shares. These are the shares which belongs to the non-controlling interest. When you multiply it by the fair value of the NCI share, it gives you the NCI value. The other method is proportionate of net assets method. So you take the net assets of subsidiary at acquisition and you multiply it by NCI percentage, it gives you the value of the NCI. Then you add these two things, it gives you the total consideration. Then you deduct the total net assets of the subsidiary, it gives you the goodwill on acquisition. Then there will be impairment. Impairment is actually the fall in value. It will be given to you in the F7 exam. And then this is the value of the goodwill which you are going to record in the statement of financial position. Then you go on to the next page. Okay, the next page is the next working is working number 4, non-controlling interest. So non-controlling interest at acquisition, which you have calculated from working number 3. And then you give the post-acquisition reserve, which was the post-acquisition share of the NCI. And if there is impairment, so you will be giving the share of the impairment to the NCI, if only there is fair value method, and that gives you the value of the NCI. Again, NCI value at acquisition from goodwill working, post acquisition share of the NCI from working number 2, and if there is any impairment, and the fair value method only, so you give the share of impairment to the NCI, and that gives you the working number 4 non-controlling interest. And this non-controlling interest will be recorded over here. Here, yes, this is the working number 4 non-controlling interest in the consolidated balance sheet. Now you have the last working, which is working number 5, group retained earnings. So you will be taking parent retained earnings from the parent balance sheet. You will be giving the parent its share of acquisition, post acquisition, because we have already given the percentage to the NCI. Now we'll be giving remaining percentage to the parent, and then parent share of impairment. Then if you remember, unwinding of discount, which was an expense. Remember one thing over here: all the expenses which are related to the parent will be deducted from working 5. All the income which is related to the parent will be added in the working number 5. All the gains which belongs to the parent will be added in the working number 5. All the losses which belongs to the parent will be deducted from working number 5. So what we are doing, unwinding of discount, because this was finance cost, so we are deducting it. Acquisition cost, such as professional fee. What is that? Professional fee means, like, for example, if when the parent was acquiring the subsidiary, they gave some fee to the firm for assessment. So that professional fee will be deducted because this is expense. Profit from associate, because associate is another investment of the parent, but that is not subsidiary. So we'll be adding that thing. Other gains and losses of the parent. And if the parent has sold goods to the subsidiary and there is profit, then we'll be deducting that, as we did in the working number 2 when the subsidiary was selling it. Now this will give you the group retained earnings. This group retained earnings will be recorded over here, working number 5. Okay, so these were all the workings, and the next video will be of the questions. And before that, you need to see these videos as many times as you can till that when you learn all the workings. So before doing the question, you need to know whatever I have explained, and you need to know all the workings.